I want to buy swaps on mortgage bonds, credit default swap that will pay off if the underlying bond fails.
You want to bet against the housing market?
Why?
So, Michael Burry. Michael Burry is one of the most influential investors there is in the world today. I mean, he's one of the brightest minds, arguably. This is the guy who predicted what was going to happen in 2007, 2008 with the American housing market, the subprime market, as we called it. And not only did he foresee this, he actually knew about this in 2005, or May 2005. And he was so confident in his thesis that this was going to be right, that he was going to be absolutely spot on, that he placed the $8.4 billion bet on it. And he literally went to Wall Street and he bought credit default swaps, taking positions that meant that when the housing market finally failed, he made $700 million for his investors and $100 million for himself personally. That's a lot of O's. So when we talk about Michael Burry, I think it's really important to acknowledge what he has done, because this is the guy who foresaw something that was an improbability. Like, it was almost impossible to conceive that it was going to happen, but he got it right. And he got it right through deep, deep, deep research. If you've not watched The Big Short, you should definitely go and watch that film. It's one of my favorite films about the markets and just finance in general. And in one of those scenes, he actually asked for someone to go and get the prospectus of all of the mortgages that had been written. And he actually sat there and read every single piece of paper through every single mortgage contract, because he wanted to add validation to his thesis that this was going to happen. So when he starts making noise and he starts predicting the market is going to crash in 2022, it's only right that people pay attention. And so in this video, I want to talk a little bit about what he's predicting. This is a concoction of things that are coming together. I'm going to give you my views, what I think. I'm also going to give you maybe a few things for you to consider on how you might be able to protect yourself if you're a first-time investor as well. I got his name right this time, Marika.
So how much of these things did you buy? I mean, you got out of everything else and bought credit default swaps betting against the housing market, right?
Right. We bought basically short $8.4 billion of credit default swaps related to mortgages or financial companies.
You must have been pretty confident that this thing was going to blow
Well,
up.
we had a giant bet for us, and I was extremely confident in the outcome.
So like I've already said, Michael is predicting that the markets are going to crash in 2022. But this isn't just as a result of maybe one thing, it's a concoction of a number of things. And the first thing that's on his radar is inflation. Now, I've already done a video where I talked a little bit about inflation, and inflation isn't necessarily a bad thing. Inflation can be good for stimulating the economy, but essentially inflation is all about the cost of things around you increasing in value. And from his point of view, he believes that there is going to be hyperinflation, which is where you see inflation rise really, really quickly over a period of time. Now, when inflation typically increases, the Fed, which is the central bank in America, will typically use things like interest rates to control the impact of that inflation. Now, all of these central banks, including the one here in the UK, has a inflation target of 2%. Well, we and the Americans have an inflation rate or target of 2%. Other countries may have something very, very similar, but for the UK and for the US, it's 2%. Now, when you have inflation over and above that 2% limit that the central banks basically set, what they will typically do is they will meet on a monthly basis and decide whether they increase interest rates to counteract that. Now, anybody who hasn't been living underneath a rock knows that interest rates have been very, very low for a very, very, very long time. And if you look at the US numbers specifically, so back in April, inflation numbers were 4.2%, which is a whole 2.2% higher than the target in the United States. So an increase there. Now, that would be okay if it was a one-off occurrence, but if you look at the May number, the May inflation number, inflation at the moment in the United States is 5%, so 3% above the 2% target. Now, the Fed in the United States have, for a very long time, said that they were not going to uh, put in any interest rate rises, certainly not until 2024. They're now reneging on that and coming back to the point of, okay, we're seeing higher than normal inflation numbers. It's a little hot out there. So they are pricing in interest rate hikes a little bit sooner, some by the end of 2022. Now, Michael Burry's argument is that, or his bet is that we're going to see inflation increase quite significantly over the next 12 to 18 months, to the point that the Fed is going to have to bring forward their interest rate hikes. And what he's done in order to make money off this is he has basically placed a bet against the value or the yields of the 20-year Treasury bonds over in the States. Now, if you follow finances, if you see interest rates increase in value, then bond yields will go down as a result of it, because you can get a better rate in your high street bank. You don't have to put it into a long-term bond to get that kind of return. So he's placed quite a large bet on Treasury, 20-year Treasury bond yields decreasing as inflation increases, and the Fed has to now pivot to increase interest rates. So that's the first thing that he's really concerned about, and that's what he's doing to make money on that side where he's positioned himself. Now, the other thing that he thinks will contribute to a market crash in 2022 is something that he alluded to in a tweet. I'm going to read the tweet for you. This is it right here. He said, all hype / speculation is drawing in retail before the mother of all crashes. So what he's basically saying is there's a lot of hype, there's a lot of speculation out there right now that is drawing in retail investors who are fearful of missing out. So FOMO. He goes, parabolis does not resolve sideways. When crypto falls from trillions or meme stocks fall from tens of billions, hashtag Main Street losses will approach the size of countries. History ain't changed. What he's talking about here is really been evidence in what we've seen over the last 12 to 18 months, right? Look at all the meme stocks. Look at GME, look at AMC. I mean, that's still going on right now. Think about Tesla stock going absolutely nuts. Think about all of these stocks that have grown so significantly over the last 12 months. And this isn't by mistake. We're living in an environment, and you have to step back to realize this, where we've already spoken about the fact that interest rates are really low. So you can't get a decent rate of return in your bank. You're not getting much really in bonds, because you may not want to put away your money into a bond for 10 to 20 years. So the next place that you would go would be the stock market. And what that means is that we're now having people flock to the stock market because there is no other way for them to get a decent return, especially considering that people have taken furlough cuts to their pay. They've lost their jobs. And so their little bit of money that they do have, they're looking to make it work as hard as possible for them. So this is a really dangerous concoction of circumstance that is leading up to what he believes is going to be a massive market crash. And that's just the stock market. If you then start looking at cryptocurrencies, Bitcoin, I mean, look at the performance of Bitcoin, increasing significantly since January, only now just falling back down to below $30,000 for the first time, it feels like, in a while. There has been so much hype around cryptocurrencies, Bitcoin, Ethereum, all of these meme coins as well that have come out, that this all adds to this speculation, huge speculation. I know people who have contacted me to say that they have borrowed money, taken out loans, taken out credit cards to invest in cryptocurrencies. And look, don't get me wrong, that is a ridiculous approach to take. You should only invest money that you can afford to lose. But interest rates are so low, as we've already alluded to. And you can use that and put that into an asset that you believe is going to balloon in value. And for many people in crypto, it has ballooned in value. And you may have been able to take profits and pay off that debt. if you've been prudent with it. But people are taking leverage debt to actually invest in the market. All of this is a really, really bad concoction that he believes is going to culminate in a huge market crash. And when we talk about cryptocurrency, we just need to have a look at where we are right now. Look, Bitcoin is in a bit of retrenchment. We said, below 30,000 for the first time in what it seems like a very, very long time. But China really cracking down on Bitcoin mining. I mean, this is a really, really big thing, wiping off 400 billion off the value of Bitcoin as they ask miners to basically crack down because of the level of energy inefficiency required to mine this Bitcoin, which takes them off their environmental targets. These are really important things. You couple that with the fact that they're asking some of their banks not to support cryptocurrencies anymore. You start to ask the question, is Bitcoin in trouble? Is cryptocurrency in trouble? Now, for many of the crypto heads out there, you may think absolutely not, it will recover. But this all adds to the concoction, this circumstance that Michael believes is going to lead to this huge market crash. Now that we've mentioned all of that kind of stuff, and I think these are really important points to acknowledge because the charts are there, the performance is there. I mean, it's what you would have heard so much about here on YouTube and on social media, is why we've got so many Bitcoin and cryptocurrency scams right now. We cannot get away from the fact that these things are all true. So if we look forward, what are the things that you can do to protect yourself? Well, there are three things in my mind. First and foremost, if you're going to try and beat inflation, and we're talking about inflation exclusively here, well, then cryptocurrencies, Bitcoin is a hedge against inflation. We've seen that. We know that Bitcoin and cryptocurrencies are not correlated to any fiat currency. And therefore, if the value of money is decreasing because of rising inflation, something that isn't tied to said fiat currency should be a good thing. It should be where you can gain value to make sure that you're outpacing inflation. But we've already alluded to the fact that there are issues right now in cryptocurrency. It feels as though we're entering a bearish season. We know that Bitcoin is significantly impacted by the fact that China isn't mining. A lot of the mining of Bitcoin happens out in China. If they don't play game anymore, what does that do for the value? And this is one of the big fears with Bitcoin, that fair enough, some people who have got into Bitcoin later may have cashed out, but the guys who got into Bitcoin very, very early, the minute those guys cash out, that's where the real danger to the value of Bitcoin lies. Will this whole episode with China trigger that? We do not know. So it's still speculative right now. So whilst Bitcoin might be a good place to go to help you combat and counteract, hedge inflation, there are challenges within Bitcoin right now. The other place that you would go would be, well, stocks, because stocks historically have outperformed inflation, quite handsomely so. Now, obviously, past performance is no indication of future performance. However, with stocks, we still have the same problem. Stocks are fine if they're not overvalued. And I've spoken a little bit about this in my members group. I've spoken a little bit about this as well on the channel and in live sessions, that in a time where there has been so much money plowed into the stock market over the last 12 months, people seeking to make their money work harder to get a better rate of return, what has happened is it has pushed a lot of these stocks on the stock market into overvalued territory. Tesla will be a prime example of a company that people will say is way overvalued for what they are currently doing. There's a lot of future growth already priced into that stock. So with that being said, if you're a first-time investor, what do you do? Well, this is my thought on this. If you're picking individual stocks, and I know that many people who watch me are, this is the time that you really have to rely on real deep research, as in like really understanding what you're buying. Analysis and research is going to be key, because if you are relying on buying 20 companies, 15 companies, or however many companies off your own volition, you need to understand exactly what you're buying. If you're unable to do that, then maybe two other approaches are best for you. Number one, going into an investment platform, maybe like Money Farm, for example. There's a link down in the description for them. They are active managers. They will be able to do research that you cannot do as a retail investor. They'll be able to have access to analytics that you will not have access to as a retail investor. Maybe using someone like that to make sure that you're invested in companies that are thoroughly researched, really thoroughly researched. Yes, you've got to pay a little bit extra for that privilege, but knowledge is power. Michael Burry does a lot of analysis. They will have access to the kind of information that he would have access to and help you make decisions from there. If that isn't an option for you, then perhaps you need to be looking at things like index funds and ETFs where you're going to get exposure to as many companies as possible. Why? Because why would you want to rely on 20 to 50 companies if you've got 50? Most individual investors who are picking their own stocks have about 20. Why would you want to rely on 20 companies with a potential market crash coming? Surely what you want is market saturation by investing in index funds or ETFs that will spread your money across a number of different sectors and a number of different companies. This is the stuff that I talk about all of the time. So that may be an approach for you. The other thing that you could do, and this is the third place to go, will be commodities. And this will be things like gold, because gold is finite. It's a finite resource. Obviously, it holds value. So it's a hedge against inflation, or at least it's a store of value. That may be a place for you to go. I know that people have actually asked me about investing in gold. Yes, you can buy physical gold, but you're going to have retail costs within that as well. Probably one of the easiest ways for you to be able to access gold will be an ETF. But again, you have to be mindful that you know what you're doing. And so in ending this video and bringing this to a close, I think there are two things that I really want to sort of hammer home. The first one is I talk a lot about understanding what you're doing this for, why you're doing it, your time horizon, how long you're looking to invest for, understanding what risk you're willing and able to take. Fundamental key things that I talk about in my course. And if you're a first-time investor watching this and you're nervous about this kind of thing, then it's $59.99. You can complete it in 94, 96 minutes and get the understanding that you essentially need. You have to be clear on why you're doing this, and you have to have a strategy. And you really need to kind of hone into that and remember what that strategy is and make sure that you are happy with the risk and the volatility that you're going to see. Because frankly, guys, if he is right, things could get very, 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 very ugly. And you have to have the nerve to hold it. The second thing I'd say is this. Look, if you're first time investing, you don't have the stomach for this, it's too hot in the kitchen, stay out of the kitchen. And there is no shame in that. If you don't want to invest, you want to just hang on and just be like, okay, I don't know what's going to happen, then by all means do that if you feel that is best for you. Obviously, you'll be missing out if he's wrong and if the markets continue to grow. Yes, you're not going to have time in the market. It's time in the market versus time in the market. But you have to do what is comfortable for you. And with that, it leads on to the second point, I guess, under this same point that I'm going to make. Many people ask me, is it worthwhile putting a lump sum or pound cost averaging in? And look, the answer to this, guys, is there is no right or wrong answer. You have to do what you feel is right for you. Yes, all the data tells us that you're better off in the long run investing a lump sum of money. But if you think that Michael's going to be right, you may not be comfortable with having 10,000, 20,000, whatever amount that you want to put in all in one go into the market, thinking that there might be a market crash. What you might prefer to do is to pound cost average that in. If that's where you're at, you have to do the right thing for you. And that's the most important thing, guys. So look, this is a bit of a long video, but it's an interesting point to talk about. And I think it's important that you understand this is a guy that people pay attention to for the right reasons. If he's right, if he is right, it could be ugly, but there could also be a lot of opportunities to make a load of money as well if you position yourself correctly. Maybe we'll talk about that some other time. But guys, just remember, you got to do the thing that's right for you. Money is a tool, life's for living. Let me know down in the comments box whether you agree with Michael, whether you think he's right, whether you think he's wrong. Did you find this video interesting? If you did, please make sure that you smash that like button and share it for me as well so other people actually get to see this. And if you haven't subscribed already, consider subscribing. But guys, I appreciate you. Have an amazing weekend. I will see you next week.